Okay, we're back with the old whiteboard again today, and today's explanation or lesson is about how much you should risk in percentage terms on each trade you make. So how do I define risk? Well, risk, I'll give you an example. Let's say you're going to buy £1,000 worth of shares in a certain stock. So this certain stock happens to be trading at 100p. Now, if you follow any of my work, you'll know that I recommend and I practice that before you get into any trade, before you go in, you need to know where you're going to get out if that trade goes against you. So you need to know your stop loss, a hard stop loss, and from that you can calculate your risk. So if this trade you buy in at 100, if it goes against you, if it goes down, let's say it goes down to 90, at that point you're going to say, I'm wrong, the trade's not working, let's get out, limit our losses. Okay, so that is a 10 point, you've got 10 points or 10 pence of risk in that particular trade. It happens to be 10% as well. So if you've bought £1,000 worth and you're risking 10%, if your stop loss gets hit, you're going to lose 10% of that £1,000, which is £100 of risk. So when I talk about risk, I don't talk about £1,000, I talk about this number here. Okay, so with that being said, if you were to trade a strategy that had, let's say it just had a 50% win rate, so half the time you're going to have winning trades, half the time you're going to have losing trades. Now, there's quite a lot of strategies out there that will be very profitable at that win rate. Ideally, with that sort of a win rate, your average winner is going to be quite a bit bigger than your average loser. So after time, after a large enough sample, you're going to come out on top. So with a 50% win rate, or with any strategy, you're going to have strings of losses in a row, as you are strings of winners in a row. But so let's say you're going to have a string of maybe 10 losers in a row with a 50% win rate strategy. Now, you read anywhere about risk, people will say, but they talk about risking 1% of your account, 2% of your account at the most. And some of the professionals, some of the big boys that trade massive accounts, they might only risk 0.25% of their account, or maybe 0.5% of their account. And there's a really good reason for this. So I'm going to give you an example. In this example, we're going to be trading a £100,000 account. Now that doesn't have to be 100, it could be 50, it could be £10,000 account, or even a £1,000 account, whichever account size you have. So if we're risking 1% on each trade, so we're willing to lose 1% of our account on each trade, and we've already said that we could have a string of 10 losers in a row, so we could lose 10% of our account in a row. So that will take this account down to 90 grand, okay? So that is if we lose 10%. Now, the losers don't last forever. We're going to come in, start making money, and hopefully get back to break even and then carry on climbing upwards. So now we currently got a £90,000 account. To get back just to break even, just to that 100 grand, we're going to need not 10%, we're going to need to do over 11%, an 11% increase on that 90 just to get to 100. So, I mean, that's doable. Yeah, that's possible. You'll carry on trading, and you'll be back to break even and then upwards. So what if we're going to risk a bit more? Let's say we risked a bit more and we lost 20% of our account. So now, this original account we lost 20% on, so now we're down to 80%, 80,000 on our account. Now, again, we're going to carry on trading and get back to break even and go on to make money. Now, to get back to that original number, we've lost 20%, but we actually need now 25% to get back to 100. So we need £20,000 to get back to that 100, and £20,000 obviously is 25% of that 80. So as you can see, the more we risk, the greater this gap becomes. An extreme example is, and I've seen beginners do this, if they were to risk or lose 50% of their account, so their account may be down to 50,000 now, to get back just to break even, just to where they were, they're going to need to make 100% on that 50 grand to get to the 100. They're going to need to double that account to get back there. Now, especially if they're beginners, it's unlikely it's going to happen. It's going to be really hard, whoever you are. When some of the big fund managers, they're struggling to beat the market, maybe do 10, 15, 20% a year, for you to get this account multiplied by 100%, double it to get back to there, is going to be a struggle. So this is just a quick diagram, a quick explanation of why you only want to risk very, very small amount per trade. There are different variables to factor in, but essentially, if you're risking 1%, you have a few losers, you make a few mistakes, then it's not going to destroy your account, it's not going to break the bank, and you're going to be able to rectify, see what went wrong, and make your money back, and then go on to be profitable. Risking any more, you could be on your way to blowing up your account. So I hope you've got a bit of value out of that, learned something, and if you're watching this anywhere but my blog at thetransparenttrader.com, head over there now, and I'll see you on the next one.